In the studio with me is portfolio manager at Prescient Asset Management, that's Johan Steyn. We're going to talk about the Prescient Africa Equity Fund. Johan, thanks very much for coming in. Just Africa, eh? No South Africa in this one?
No South Africa.
Okay, and the history of the fund first of all, how long has it been going?
So we started this fund about 3 years ago after being convinced that we want to take an Africa allocation. We're convinced that in our balance funds, for example, we want to be exposed to high growth markets. So we've been putting China on the one hand and Africa on the other hand. We've kind of recognize that those are the growth markets you want to be exposed to, yes. And we've launched funds in both those markets to kind of exercise that view in our balance funds, and we've taken these funds to the market as well. So we've got a 3-year history, so since April 2011 that we've been running this fund. We'll
come to that history in a second, but if you look at the China story first of all, I mean, it's been going through the roof both in 2014 and early 2015. In the last few days, I think it's meant that it's a 22-23% rally in 2015. How about Africa? Has it fulfilled the promise that you put in it in 3 years ago?
Well, in the early stages, the first 2 years, we had phenomenal performance, in rand terms in the 40s, and it kind of was an effect that, it's playing out too quickly in a sense that, there's such strong growth. And that was also the point in time where we saw a lot of liquidity in the market, the quantitative easing, flushing the market with a search of yield. So a lot of money flowing into kind of illiquid markets, so pushing up those markets quite quickly. Yes. 2014 has been a bit of a weaker year, and I think there generally it was Nigeria that drew that performance down. So although we saw stronger performance from markets such as Egypt and Kenya, it was Nigeria that just kind of fell to the bottom, being dragged down by the decrease in the oil price.
Yeah, well, let's talk about Nigeria now, because is it the case? You talk about global liquidity, which drove relatively illiquid markets in Africa higher. Does the international community look at Nigeria and look at the relative political instability and also the threat of terrorism and a few other little incidents, plus the oil price, of course, which is the major factor? Do they then withdraw their money, and therefore that was why we had a 2014 underperformance?
Yes, exactly. And I think it's also a case that there was a lot of international investors already in the market in Nigeria. And as soon as the oil price fell, I think there was a big fear that the Naira will weaken, and it did subsequently weaken because of the rush for the door. So a lot of investors trying to withdraw their money out the market, and subsequently had a equity market falling, a weaker Naira. So in US dollar terms, the Nigerian market, was quite depressed. I think another factor that weighed on investors' sentiment is, like you mentioned, like the Boko Haram insurgency. They read,
yes.
In the newspapers, I think something like that grabbed global headlines, like a terrorist kidnapping girls. It's a very emotional type story.
It's a psychological factor, although exactly. It's not really going to affect the bank, for example, that you might be invested in. But it does play on people's minds, unfortunately.
Absolutely. So as an international investor, they look at these things and they ask themselves, well, do I want to be exposed to a market such as this? So it definitely weighs on investor sentiment. Leading up to the election, I think there were many political commentators out there that emphasized that this is going to be a tightly contested election. Now, a tightly contested election in Africa for the international investor typically means there is a heightened risk or probability of disruptions or allegations of fraud, both parties calling victory too soon, and the kind of potential for violence to escalate, like we've seen in Kenya. Yes. In 2008, in 2007, 2008. So that kind of makes investors, or increases the risk perception, and makes investors withdraw ahead of it. Now, when you have a kind of free and fair election and a conclusive election, which appears legitimate by all means, then you have a situation where that political risk and that uncertainty rolls out quite quickly.
Yes.
So what we've seen in Nigeria is, as soon as those announced results, those results were announced, the market, we count about 17 counters being limit up 10% within the market.
So a massive great relief rally.
Exactly. And that is a case of the emerging market funds, I think, being underweight Nigeria on the back of all these commentators saying there's this perceived or heightened risk looming. You could have a drawn-out process, so a lot of political uncertainty. With all that disappearing in one shot, you had massive amounts of money trying to rush into a market where there's no sellers, and in a market where it's already an oversold territory.
Yeah. So the trick is now, of course, maintaining this bullish enthusiasm. We can't have limit up every day, of course. The reason that you're probably talking so enthusiastically about Nigeria and focusing on that is because A, it's the biggest economy on the African continent, and also because its market is probably a little bit more liquid than, for example, the Rwandan market, something like that. Is that are they two of the factors that you put into your investment equation?
Absolutely. So if you're going to look at, from a standpoint of an international investor, trying to get Africa exposure, and you realistically look at the breadth and depth of some of these exchanges, and you're trying to compose an investable universe, and you apply a size and a liquidity screen, your investable universe reduces quite quickly from the, say, 1,000 odd listed across the continent to about 150 odd. Yes. And a large component of that, say 40% is Nigerian equities, so listed equities, and a large proportion of those are Nigerian banks. So say another 40% of that.
Top 10 equity holdings, a neat segue into your top 10 equity holdings. It goes here: bank, telecoms, tobacco, bank, telecoms, electricity, petrochemicals, and then something called Oriental Weavers. Banks obviously dominating your portfolio. Of all these banks, all those numbers that I just read out, how many of those banks are in Nigeria?
Well, of those top 10, we've got two accounts in Nigeria, Guaranteed Trust Bank and Zenith Bank. So we prefer your higher quality banks at this stage. Yeah. We do believe that there's good value to be had, and some of these accounts have been oversold and they haven't really recovered to their highs of last year, for example. However, the banking sector are facing a number of headwinds. So although some of your tier 2 banks and your lower quality banks are looking very cheap, by comparison, they are pricing in risks that we would argue is quite realistic in the sense. So you've got a lot of factors playing on in the banking sector that will drive profitability going forward. A number of headwinds, but considering the comparison between sectors, I would still say that the banking sector would be better poised, especially from an investment perspective, to survive the tougher conditions we're going to see in the shorter to medium term in Nigeria.
Are you looking at Nigerian banks that are mainly exposed to the retail market? And if so, is Nigeria underbanked?
Well, the answer is yes to the first question, and the second, absolutely. You've got a massive population in Nigeria. So, and it's also a reason why you've got so many banks, and the banking model, or a large component of the banking model used to be gathering cheap deposits from this large population and then just simply buying risk-free assets and then benefiting from that spread. Now, to some extent, the central bank has tried to reduce that ability for banks to do that by increasing what they call the cash reserve ratio. So first of all, they increased the cash reserve ratio on public sector deposits, which meant that if you took a deposit from a public institution, like a municipality, for example, you had to deposit 75% at the central bank. So you couldn't buy Nigerian bonds with that. So you can't lend the government their own money back and make a profit from that. And they wanted to encourage the banks to stop participating in the real sector. So you're increasingly seeing banks participating, looking for good quality assets, and you're seeing an environment where there are a lot of banks doing that. So increased competition, first of all, which is going to play. Yes. On gathering asset quality is going to be very important. So getting good quality assets, yes. And we've seen high credit demand growth in the market. Now the question is that sustainable? And the answer, over the longer term, yes, but we're going to see over the shorter term perhaps a slowdown in that credit demand growth.
Sounds like a dynamic environment, and presumably second-tier banks will be coming through as well. Let's move on to telecoms now, because that's your next biggest holding. That just keeps on growing. But again, so much competition, margins shrinking.
Yes, and that is, I think, because of the telcos going through that natural cycle of they reach a high level of penetration. Their high growth that was driven by high growth in voice is moving into data. So your growth in voice reaches a plateau, and as these telcos mature, but they're generating a lot of cash flow. So they are investing into infrastructure, although your free cash flow generation tends to be quite high. The question becomes, is data going to be a strong enough growth avenue to make up for your slower growth in voice.
Yeah.
And time and again, if you look at across markets, the Kenyan market or Egyptian market, we've seen that growth in data. It's quite high.
Yes.
But
But as you say, the question is whether it can make up for the very high margin of voice traffic. And we've seen exactly the same in South Africa with 2 of our local operators putting their prices up. What about the future? Because the one thing I noticed that is glaring by its absence, and that's consumables. I mean, FMCG companies, that sort of thing, retailers, why not?
Well, at this stage, we consider them to be quite expensive on the one hand. So our investment process is kind of driven by trying to assess what risks are we getting rewarded for taking. So if we look across different sectors, your direct consumer-facing shares tend to be quite expensive right now. So the likes of your Nestle Nigeria, for example, or your East African breweries in Kenya, for example, they're trading at very high multiples and in effect discounting the high expected growth. So there is a really strong structural growth story out there, a potential of an emerging consumer that's going to drive growth over the longer term. However, currently, we think over the shorter term, there are risks that are not being adequately priced in. So there's a number of risks impacting the Nigerian consumer company right now. One, for instance, they're importing a lot of raw materials, and you've got a weaker naira, so you're going to see that effect coming through in their cost of goods, and their ability to pass on those prices, or the increase in prices, are quite limited because you've got a consumer that's kind of under pressure currently. You've got disposable income shrinking, not a lot of real wage growth in the public or private sector coming through. So that's in the short-term story, doesn't look that great. You've got headwinds like inflation. So you're going to have a margin squeeze impacting the profitability, and they're trading at PEs of between 30 and 40 times. So from our perspective, is the case is there's a higher risk of them not meeting their growth expectations, and thereby in the short to medium term, you're going to have a risk of permanent loss of capital if you buy these shares at this stage.
So it's an overvaluation situation, but again, with so many companies coming in, and with the populations, particularly in countries that we've already mentioned, being so buoyant, the demographics being so buoyant, and it must be one to look at in the future. Who should be investing in the Prescient Africa Equity Fund? It's open to retail investors, of course.
Yes. I would say somebody that has got a higher risk appetite than your typical equity investor in your advanced or developed or even the South African market, because you have to realize it is a emerging and frontier markets we're dealing with. So there are always these looming risk issues, and you have to have the ability to kind of look through the short-term fluctuations, and so your risk appetite needs to be higher. So you have to.
So it should be a relatively small part of your total portfolio.
Absolutely.
Okay, Johan, we'll have to leave it there. Thanks very much for popping in. That's Johan Steyn from Prescient Asset Management, talking about the Prescient Africa Equity Fund.